need to make decisions for yourself, not mimic other people making decisions for you. You want to trade the biggest when the market's good. You want to trade the smallest when the market's bad. If you have a downward trending equity curve, you haven't earned the right to size up.
Keep it simple and keep it consistent. Nail down the basics before you can build that intuition to become a little bit more creative in stage 3.
You can't mimic a stage 3 just to be a stage 3. You have to earn your way to it.
Our goal with position management, once we're positioned in a promising stock, is to capture the trend relevant to our time frame.
Position sizing really comes down to experience at the end of the day. So what I tend to see is a lot of people generalize position sizing independent of the stage that they're in. If you're a stage 1 trader, we'll have very specific guidelines coming up. You can't put a position size at 20-25%. You don't have enough experience to do so. You haven't earned the right to even go that high. You don't really know what you're doing. You don't know your stats. You have no idea what the hell you're doing. And if you don't know that stuff, there's nobody, you don't have any right to go 20, 25, 30% that stage 3 traders do. And that's kind of, the downside of social media as well. A lot of people seem to think that, if trader X on, is doing this, I need to do the same thing for me to match, kind of, to be him in a way. So let's say if Dan Zanger is putting up a position size of 20 to 25 or 30% on a single name, he's been in the market for 35 plus years. Ross has been in the market for 35 plus years. Mark Minervini has been in the market for 20 plus years. Stan Weinstein has been in the market for 40 plus years. These people have earned the right through experience to get them to those position sizes, and you do not have a right from year 1 to 7 to be doing that to yourself, because it magnifies your emotion. It allows you to make bad decisions. That's why you're a stage 1 and 2 trader, because you're not taking the journey into account as to how those traders that you follow got to that position size, right? So keep that perspective in mind. If you see someone putting up a 25%, 30%, 40% position size, 50% I think is stupid, but some people do it. It works for them. Your blow up risk as stage 1 and 2 traders, you don't have the emotional experience, you don't have the mental experience, you don't have any experience at all to handle those situations, whereas they do. They know how to handle it when things go bad. You don't know how to handle, when things, so don't size up too fast. That's the 4th point that we see on the slide. The second aspect to it is position size with momentum. So if you're stringing together a few wins in a row, let's say I put up a 5% position, right? And I have 3 names, 5% position, each of them hit an 8% gain, and I see momentum in the market's communicating back to me and saying, this is a good environment. I'm rewarding you, and I have a string of 3 wins that I have, and the market's telling me it's a good environment. I can then move my position size, let's say from 5% to 8%, and see, hey, is the market still rewarding me, right? Keep the series of trades, keep the whole journey of, you're going to make 500 trades over a span of, I don't know, 3 to 4 years, depending on what type of traders you are, right? Keep those in mind instead of, hey, I need to size this up at 30% because X person on this posted this and I follow them and they're doing this. They're way ahead of where you are in your journey, and you need to make decisions for yourself, not mimic other people making decisions for you. The second is, as you hit a wall, as markets get choppy, as environment gets bad, as the May to September run and September to now ended, right? The run's now ended. Things are getting slapped lower, breaking the 50-day ELF, CELH, these type of stocks as they're coming back in. If you're still placing the same bullish position size, right? You're still going long with the same position size that, let's say, you were in May at the start of a trend, and your drawdown from your highs is more than 5 to 10% already. What are you doing? Because you're working against the market. Your math is working against the market as well. You're not putting on test positions. You're putting on full positions to test the market. That's insanity, right? At the end of the day, and a lot of traders do this. They don't look at how much of a drawdown they have from the top, how much they have scaled back from their highs. They're not looking at the numbers, and they're just not aware. And the momentum that comes, from that, which is feedback from the markets, is consistently negative, but they refuse to reduce their position size because they feel like, hey, it's going to work. The next one's going to work. The next one's going to. But if the market's saying you have 4 losses in a row, you have no right to go to full position size at that point in time. You have to, go from your full position size to an 8th or a 16th of what you're trying to do. A 16th to test the market and see if the waters are again, warm enough to swim at the end of the day. So that's the second aspect of position sizing. If you do it with momentum, right, keep the bigger picture in play where you have 3 to 4 to 5 trades, you string together in a row, then you step up, you turn on, a switch and you say, okay, now my position size goes from 5% to 7% or 5% to 8%. But have some mechanism so that you're taking the staircase up to position sizing, not just going to 30. Thing doesn't work, and you still put on 30 because you feel like the market's about to turn around, right? So let's get into some of the guidelines next. So trade your biggest size when the market is cooperative. Easier said than done, but a series of trades will always give you the information and the market to talk back to you. Trade the smallest. You want to be trading. So these guidelines this is what you want to be doing. We'll get into how you do it in the next couple of slides, right? You want to trade the biggest when the market's good. You want to trade the smallest when the market's bad. You want to stack up your probabilities. There are different ways you can have, average gain, average loss, break, open risk, etc. But you want to stack your probabilities by counting the number of edges that a setup has and then size according to that. That's one way. That's how I do it. It takes time and experience. We already talked about that. You have to pace yourself. You have to go from 1 to 2, 2 to 3 as the different stages and how you evolve as a trader. And the last bit is, yes, you can size up, but you have to earn that size. And it boils down to, you can put on big position sizes and your equity curve will still have relatively low volatility if you've built up the experience to earn that right to get to 25 to 30%. So now we're going to get into like stage 1, as a stage 1 trader, if you're a stage 1 trader right now, some general guidelines is just so how do you get from stage 1 to 2, right? We're just talking to stage 1 to 2 right now. So if you're a stage 1 trader, put a max stop loss rule into play. Just put that into, put that rule, have that, and that will curb your losses, right? That will minimize what you're doing. That's just one step towards turning around your equity curve as stage 1 traders. The second is reduce the number of positions. I see a lot of stage 1 traders have massive, portfolios of 15 names. They have no idea what they're doing. They have no idea how they could track this stuff. And they have really they don't have the stats to even, 10 names is a lot of names. Get it less than 10. You could concentrate on what's important. At least, again, it will curb your downward trending equity curve. The third most important point is you haven't earned the right to size up. And that's the reality of it. If you have a downward trending equity curve, you haven't earned the right to size up. Keep it to 8 to 10%. I don't care what anybody else says. Size magnifies emotion, yields poor decision making, and you don't have the experience on top. You're going to lose money in the market as stage 1 traders. So you need to reduce that size, get comfortable with that 8 to 10%. Do that over and over and over again until you have a higher low on your equity curve over multiple market cycles, and you could prove it, visually to yourself, or you could just tag me on Twitter and I'll say what's going on. But prove it to yourself with that 8 to 10% before you go to that next step, right? You have to be comfortable at 8 to 10%, know your numbers so that you guys can really turn this ship around from stage 1. Richard, anything to add in terms of general guidelines for stage 1 traders?
Yeah, I think as we'll get into, keep it simple and keep it consistent. nail down the basics before you can build that intuition to become a little bit more creative in stage 3, as we'll get to.
Awesome. So the only difference here, stage 1 and stage 2, it's kind of the same thing. Now you're a boom bust type of trader. You know something's working and you know that you give it back, right? So you have a max stop loss rule and you know that you need to curb losses. You figure that part out. You know that the number of positions that you have should be less than 10, and you need to concentrate your portfolio to a certain number of stocks so that you can manage those well. Now at stage 2, I think you're in that where you've moved away from 8 to 10% and you've kind of migrated to 12 to 15, but your losses are still bigger than your gains, right? So you're still trying to figure it out, but you've earned some right to go from 8 to 10 to 12 to 15 at the end of the day, right? So that's kind of the only difference I see. Richard, if you want to add anything for stage 2 traders, yes, you're still downward trending equity curve, but you have enough experience. Most stage 2 traders are around year 5, 6, 7 in the markets, and they have a good feel for what's going on. They know what's profitable, but they're not serious enough because they're not keeping the numbers right in terms of what they're doing. So anything to add?
No, not really. Just
Yep.
probably at this point, you're starting to think much more about focusing on the loss side of the equation and keep those numbers in check. So you'll be more aware of where you stand with that, and really focusing on trying to cap that downside. It's still might not be working all the time, but you're more focused on that side of the equation.
And stage 3 traders, usually, if you look at some of the most successful ones recently, David Ryan, Stan Weinstein, Ross, Mark, any of these people that have earned the right to position size higher, is that they're stage 3. They know how to get out of bad situations, and they know how to work in high pressure situations, even though that they size up quite a bit. They still keep their losses pretty, they're looking at, when they enter a stock, they're looking for directional movement. And if it doesn't give them directional movement, they get out, right? So they're either the market's doing what they anticipated at the end of the day, or they're taking that loss and moving on to the next. And then, they're concentrated. They're concentrated on 5 positions at 20%, let's say, or 4 positions at 25%, and they could pick the best stocks with the best potential in the markets because they're stage 3, and that's a very important point that everybody should kind of pay attention to. You can't mimic a stage 3 just to be a stage 3. You have to earn your way to it, and you have to build the appropriate experience for you to even get to this. And we're talking about people that have been in the markets for 15, 20, 25, 30 years that could put on 30, 40, 50% positions and be perfectly fine because they know how to manage their risk. So with that, we have an example. So this is from a spreadsheet that Anish at the IBD meetup that we did a while ago put together. So I took a screenshot of that, and we'll kind of go through. He did there's a whole video. I think it's an hour or 2 hours where he just spent, time on position sizing. I think that one's going to be a good watch as well. But I'll try to, go over this as to how realistic, this example is fairly realistic if you were to keep, tabs. So this assumes that, you have a batting average of 45 and your position size per trade is 25%. Your average gain is much higher than your average loss. That means, what does that mean? You're kind of stage 3, right? You're about twice, you're keeping your losses very tight and minimal. And let's assume that you have a account size of 10,000. So the way this is broken down is that your first trade here and your first 4 trades are losses. And the position that you're putting on, 1250, 1250, and 1250, you test the market 3 times, and the market says, nope, nope, and nope. Now you're losing money. You started with 10,000 and you end up with 9,800, 9,870 in your total. So you reduce your position. So the key here is as the market gives you negative feedback, right? You put on 12, this is dollars, by the way, 1,250, 1,250, 1,250. Now you reduce your position size because the market says this is not a good environment. It's not a good environment. It's not a good environment. Now the next loss that you take with a lower position size, which is 6% of your account, basically, you still take the loss of 3% and you still give back money and you keep that size low until you get positive feedback, right? So once you get positive feedback from the markets, let's say you put on that 6% position and the market says, okay, I'm going to reward you. The market environments change, things have turned around, and you have a 10%, gain. You make progress. You finally make progress towards break even. And then your next position, you can kind of scale up, right? Now you're scaling up to that next level, that next switch or that next step, whatever you want to call it. The market rewards you again. Now you're above break even. Now you've earned the right from trade 5 to trade 7 to go back to the position size that you started with. And this is, it's always relative. So you went from $625 to $937 being invested. Now you've gone to $1,250 as your position size. And again, the market rewards you and says, okay, this is assuming an average gain of 10%, by the way, and an average loss of 3. So these are 3% losses, 10% gains. But the most important part here is trade 5 to 7. You've earned the right to go back up. The market environment remains good. And now you're making some progress. As you step up your position size, right? Now you're at $2,500 of the 10,000. The market says, no, here's a 3% loss, dishes you another 3% loss, and dishes you a whole bunch of losses in a row. But what this is trying to demonstrate is that your position sizing should step down as the market becomes less and less cooperative. So now at this point, even at trade 14, from trade 8 to trade 14, you've had a string of losses. If you kept this at 2,500 all the way through, you would have lost a lot of money. And your drawdown from your highs would have been a lot more. And your drawdown from 10,000, which is your equilibrium point, would have been a lot more as well. So the fact that when the market tells you, hey, you're wrong, here's a 3% loss, you take it. You're wrong, here's a 3% loss, you take it. And then you say, okay, I need to listen to the market. I need to reduce my position size because if I keep going at this rate, I don't know how many losses I'm going to have in a row, but I need to scale it back. And once you scale it back, then you start over again, right? Okay, the market says 625, here's a 10% gain. Okay, something's changed. The market's saying you're good to go again. There's a 10% gain. I'm going back towards break even. Here's another 10%. Then you start stepping it up, and there are going to be environments, and we'll talk about this in webinar 6, I believe, when we get into market cycles. This is essentially the market communicating bad market, good market, bad market, good market, right? And that's the market cycle. At the end of the day, it's rewarding you, right? And you earn the right to step up your position sizes from trade 15 to, let's say, 23. This is really getting crazy, right? You're now at 100%. So this is not a realistic example at this point. You don't want to have one position, $10,000. That's, you're putting your whole account into one. But at that point, you're making progress because the market's cooperative, but you're stepping up your position size. And what happens at trade 24 is very realistic. The large gap down, right? You put on a position and you get completely whacked. And the market says, you need to slow down. Something's not right. Or it could be a big gap down. Let's say you put 10,000 in. It's not a 3% average loss, and it's an 8% average loss at that point. Not an average loss, but this loss, for trade 24 could be 8%, and you lose a whole bunch more than you anticipated. But then having these stats in mind and the series of trades, you will see relative, this trade set me back basically to trade 21 or 22. If this was 8% or 9% gap down, it would have set me back to trade 20. But it gives you a perspective of, hey, I'm still fine. I'll take this loss and I'll continue forward because I have an idea what my numbers look like. Then, so the idea of this slide is you earn your right to position size up as the market gets good from trade 15 to trade 21. And you have to listen to the market when you have a string of losses together to position size down, because then you're testing the market bit by bit, right? And if you work upon this framework, eventually as stage 2 traders, you turn that situation around where your average, even if your average gain is 5% and the average gain is 4%, you're going to come out on top, because that's mathematically what's happening. But at stage 3, they really minimize their losses because they're really good at taking losses. They're not sore losers. They listen to what the market's saying, they take it to the chin, and they really position size according to what the market is really telling. Any questions on that, Richard, or any comments that you want to add as to how this kind of works back and forth?
Yeah, I think this concept of progressive exposure, it's definitely a little bit more advanced. So stage 1, stage 2 traders, keep an eye out for that. Ryan, I wanted to see, before we move on to position management, can you touch on a little bit how you position size based on the number of edges that you feel like a trade has? So I think that's another important point to cover here.
Yeah, so let's say a good example is that I remember that me and Ross both graded was the Amazon 2020 coming out of the COVID correction, right? So Amazon had a couple of things, two things actually. So it had relative strength in the markets, which is an edge that we look for. And then it had a big bar, which resulted in, big, massive volume to the upside. So it had two things going for it. The fact that the RS line was making a new high before price, and the second was the fact that it was just exhibiting an RS phase. So me and Ross kind of piled up on that name, and there was a pivot that we set, and the price moved above that pivot, and we really sized that up. But that was based on the number of edges. So the market was pointing in the same direction. That's one. That could be a market edge. The second is relative strength that it was exhibiting. So those two facts combined, that position for me became a 30% position instead of a 20%. If it had just had one of the two quantitative factors that I look for in terms of the number of edges that I have, right? Let's say it has in a correction, that name also had 62%, relative strength as well. So 62% of the time, I know my stats, so I banked on that kind of, to make sure that I size up on that name. So that's how I kind of operated, was more edges that I see on a single name. I position size those names higher because my probability of seeing success on those names is higher because multiple things are aligning on that same name. And if it's this, another name where only one of the edges is present, I position size less because my probabilities don't tell me to go all the way to, let's say my max position size is 30%. So I don't know if that makes sense. Maybe we need a visual example in future webinars, but that's kind of how I go about it.
Yeah, great. I think we can move on to the last section here today. And I know a lot of people have questions about this position management and sell rules. We'll touch on selling into strength, selling into weakness, all of this. But, keep taking it back to the kind of key points here. Our goal with position management, once we're positioned in a promising stock, is to capture the trend relevant to our time frame. A position trader might look to capture the trend above a rising 50-day moving average, or 65 EMA. A more stage analysis typed investor might look to capture the trend above a rising 200-day moving average. For me, I operate more base to base above a rising 21 EMA. That's my time frame. Focus on capturing the trend that's relevant for the style that you've adopted, because all the risk parameters and all that is going to be dependent on your style. And you want to stay true to that. But you also want to make sure that you let the stock work for you within those constraints. And that means let it trend above a moving average, experience natural pullbacks, all of that. That's normal price action that's going to happen. And as the stock continues to work and doesn't violate any sell rules, you want to make sure you give it room to actually make progress for you. In strong markets, give it the benefit of the doubt. There may be intraday shakeouts below moving averages that close above it. DocuSign in 2020, that's one that taught me a lesson there. I got shaken out below the 21 EMA. It rallied and I had to buy it back at another entry point. But in choppier markets, you want to be very restrictive and tighten down on your risk parameters. And if the stock isn't acting right, don't really give it any room to wiggle around. Make sure that you're protecting your capital and gains at all costs. So